Good morning and welcome to the deep dive. We are really tearing into the core themes pulled from today's Bulls, Bears, and the Bell Morning Edition brief. Thank you for joining us. If you're just glancing at the screens this morning, you might think, okay, markets are just sort of coasting. But underneath that calm surface, we are seeing some really profound and honestly historically strange contradictions playing out.
That's absolutely right. I mean, the current market environment, it's really a masterclass in global divergence. We're not really operating on a foundation of, synchronized economic indicators anymore. Instead, you've got these big policy decisions and, well, pure political outcomes overseas creating massive movements, while here in the U.S., our markets are just trying to function inside this information vacuum.
Okay, yeah, let's unpack that. This is definitely an unusual situation. So our mission for this deep dive today is to really isolate and thoroughly analyze the three dominant forces. And they often seem contradictory, don't they? These forces defining the trading week. First up, we absolutely need to understand the powerful influence of these political shifts, especially that explosive rally we're seeing in Japan. It seems purely policy-driven.
Right. And second, and this is probably most critical for the U.S., we'll dig into the severe challenge posed by the government shutdown. I mean, this shutdown, it isn't just some inconvenience. It's creating a fundamental data void. It's forcing investors, policymakers, even the Federal Reserve itself to rely on proxies and, frankly, a lot of speculation.
And third, we're looking at this sort of quiet period right before the highly anticipated Q3 earnings season kicks off. And, without reliable government stats, corporate earnings, particularly that forward guidance from CEOs, they're about to take center stage. They might be the most reliable real-time economic indicators we actually have right now.
Yeah, exactly. The central challenge, the intellectual puzzle for every sophisticated investor right now is figuring out how to navigate an environment where the central bank itself is effectively, well, flying blind.
Yeah.
Without those critical, comprehensive, timely economic reports, the risk profile of every policy decision just goes up. It turns what should be clear market signals into potentially misleading noise. We need to try and cut through that noise for you.
Okay, well, let's set the stage then. U.S. futures are pointing modestly higher this morning, suggesting a generally constructive tone. But like you said, the real story is buried in the nuances, the contradictions. Let's start with that global snapshot and this really remarkable policy divergence. All right, looking at the U.S. index signals early this morning, the tone is definitely positive. You've got the major indices, the S&P 500 futures, the Dow Jones futures. They're signaling a modest open, kind of suggests a cautious continuation of the uptrend we've seen recently.
And the NASDAQ 100 futures, representing those tech mega caps, they're also positive, showing gains around, what, 0.5%? So that might point towards a potential reversal, maybe, of some of the slight weakness tech saw recently. But the real insight, I think the true health signal we really need to focus on is coming from the small cap segment.
You're talking about the Russell 2000 futures, the RTY. Yeah, they are showing significant relative strength compared to the large cap indices. So why is that outperformance such a crucial signal, especially right now?
Well, it's a classic tell, really. Small cap companies, just by their nature, they're inherently more sensitive to the domestic U.S. economy, right?
Yeah.
They generate most of their revenue here domestically. They're less insulated by things like currency hedges, and they rely much more heavily on stable U.S. consumer and business spending. So when investors show a healthy risk appetite by, aggressively buying small caps, like we're seeing now with gains pushing up towards, what, 0.75% pre-market, it sends a couple of specific messages.
Okay. And those messages are...
Well, first, it suggests confidence in the domestic growth outlook is high enough to justify the higher risk profile you take on with these smaller companies. And second, it suggests that the market momentum isn't solely stuck in that mega cap AI story,
Yeah.
We seem to be seeing a broadening out of risk appetite into cyclicals, into domestic businesses. That indicates some resilience. It suggests that even though the political noise is, well, deafening, the underlying belief in U.S. economic stability might still be pretty strong among investors. It's actually a critical countersignal to maybe the pessimism you might expect from all the shutdown news.
Right, but that domestic optimism, it just runs headfirst into the starkly divided international picture. And Japan is just, wow. It's absolutely dominating the conversation today. We're talking about the Nikkei 225 index surging by almost 5%, reaching a brand new record high. I mean, that kind of single-day move in a major developed economy index is, frankly, shocking.
It is extraordinary. And what makes it really fascinating is the cause. This isn't driven by some unexpected GDP beat or a massive corporate earnings surprise. No, this rally seems purely a response to a political shift. The ruling party has selected an ultra-conservative leader, and the market immediately translated that political outcome into a very, very specific monetary policy expectation.
So the key assumption the global market is making is that this new political leadership basically guarantees continued accommodation from the Bank of Japan, the BOJ, like no change is coming.
Precisely. The policy implication seems crystal clear to the market anyway. They believe this leadership change removes any lingering doubt that the BOJ might have had about, maybe exiting its ultra-accommodative stance. They expect interest rates to stay suppressed, quantitative easing to continue, maybe even be enhanced. This expectation effectively just kicks any path toward monetary tightening that people were speculating about further down the road, or maybe abandons it altogether.
But wait a second. Isn't there a risk here? That the market is maybe getting ahead of itself over anticipating this policy continuity. I mean, political leaders, even ultra-conservative ones, they eventually have to face reality, right? Inflation pressures, bond market yields. What if the BOJ surprises them?
Oh, absolutely. That is the latent risk, no doubt. But for now, the momentum is just overwhelming because of the immediate direct benefit this policy divergence provides to corporate Japan. See, this expectation of continued accommodation, it immediately weakens the yen against major currencies.
Yeah.
And a weaker yen, that's a massive tailwind for Japan's corporate giants, specifically those big export-oriented sectors like automotive manufacturers, heavy equipment, consumer electronics.
Ah, right. Because when they bring those massive overseas sales back home and convert them into the devalued yen, their reported earnings just look significantly higher.
Exactly. It's an immediate, policy-driven boost straight to the bottom line. The company doesn't even have to sell a single extra car or TV. This sets up a really powerful, easy-to-grasp macro theme for global capital flows. Bet on Japanese equities because policy is deliberately boosting corporate profitability. It's like a textbook example of capital just flowing where accommodative policy seems guaranteed.
Yeah. And we should probably mention briefly that elsewhere, say in Asia and Europe, the picture is much more mixed, sort of subdued openings in Europe, Hong Kong and mainland China showing negative or flat movement, partly due to holiday closures too. Japan is really just operating on its own powerful internal catalyst right now. It's quite something. Hashtag tag 1.3 commodity and currency cross currents. Okay, moving over to commodities. WTI crude oil is showing a bit of a rebound this morning, up around, 1.6%, trading near $61.86 barrel. That looks okay on the day, but like you said, context matters. It's really just clawing back a little bit from a pretty brutal 7% drop last week.
And that context is absolutely key. While we see this modest rebound today, the broader trend is, unmistakably bearish. The market seems to have shifted its focus pretty hard onto supply surplus concerns. We're seeing reports of rising output from OPEC Plus and non-OPEC producers too. Analysts are already positioning themselves for this bearish trend to continue. Many are citing that long-term surplus outlook is likely to cap any significant sustained rally, probably keeping it below $65 a barrel. So yeah, this little rebound, likely just transient unless we see some sudden geopolitical shock,
Okay. Meanwhile, gold is flashing that classic safe haven signal, isn't it? Rallying up 1.4%, getting close to that $3,965 per ounce level.
Yeah, gold is benefiting from, the general uncertainty that's just inherent in a world defined by geopolitical risk. And interestingly, the U.S. domestic policy gridlock, too. These factors just burnish gold's appeal. It's also getting a bit of a lift from a slightly weaker U.S. dollar index, the DXY. It's trading around 98.10 right now.
So what forces are really dictating the dollar index's position at the moment, especially when the domestic picture here is so cloudy?
Well, the dollar index is pulling back a bit from its recent highs, mainly because the market is aggressively pricing in the strong possibility of further Federal Reserve rate cuts.
Yep.
And this expectation, it's fundamentally reinforced by that U.S. data void we're about to dig into more. See, when the Fed loses its clear view of the economic fundamentals, the default expectation tends to be that uncertainty will just force them towards a more accommodative, dovish stance, just to prevent a self-fulfilling slowdown. And that sentiment puts downward pressure on the dollar, even if the actual economic trajectory remains pretty unclear.
Okay, this brings us squarely to the most defining challenge for the U.S. market this week, this data void. The ongoing government shutdown, it's indefinitely postponed key economic reports. We know the big one, the employment situation report, non-farm payrolls, was delayed. But what other specific high-impact data points are we actually missing that fundamentally blind the Fed?
Oh, the blindness. It goes way beyond just NFP. I
Yes.
mean, we're missing crucial manufacturing and industrial data, things like factory orders. We're missing key inflation gauges that come from government sources. And critically, we're missing those real-time indicators on housing starts, building permits. These reports normally give the Fed, and bond investors too, that granular detail on the speed and trajectory of economic growth and where inflation pressure might be building. Without them, the Fed is just forced to rely disproportionately on incomplete, less comprehensive, and often much more volatile private sector data.
Right, like that recent ADP report which showed a surprise drop in private payrolls. That signal, taken all by itself, must have been way more jarring to the market than if it had landed next to the full NFP figures for context.
Absolutely. The lack of government data creates this vacuum where every single private sector release just gets amplified. It's put under a microscope. And if the Fed actually makes policy based on those volatile, isolated signals, their risk of making a policy error, either tightening too much or easing too much, just goes up dramatically. The Fed's own models, their projections, they rely heavily on timely government stats. When they don't have those inputs, they truly are operating at a severe informational disadvantage. They really are flying blind.
And the scarcity of information, it leads to what we've been calling the data dump event risk. When we look back at historical shutdowns, what's the actual mechanism that causes all that market volatility when the shutdown finally ends? Is it just the news itself?
Well, in past shutdowns, what we've seen is the resolution is often followed by a rapid, sometimes almost simultaneous, release of all the backlogged high-impact reports. Not just one, but potentially weeks of data hitting the news wires all at once. Just imagine getting a month's worth of inflation data, labor market numbers, housing stats, all within maybe 48 hours. This sudden information deluge, it prevents the market from absorbing and properly digesting the news gradually like it normally would. It forces a really rapid, compressed repricing of risk across interest rate expectations, across equity valuations.
So the volatility isn't necessarily driven by bad news per se, but just by the sheer speed and volume of the information hitting the system all at once. It's almost like a liquidity event disguised as a fundamental one.
Precisely. That sudden velocity can trigger large, unpredictable swings, especially in the treasury market. And that then cascades straight into the equity markets, leading to significant volatility that, frankly, the market seems completely unprepared for right now. Hashtag 2.2, the volatility paradox.
Okay, and this brings us right to the profound contradiction sitting at the heart of the U.S. market today. The volatility paradox. Despite all these known very material risks, the shutdown, the data void, the potential data dump risk, the CBOE volatility index, the VIX, it just remains stubbornly subdued. Closed recently at 16.65. I mean, historically, that's a very low level, and it's down significantly year over year, too.
Yeah, the VIX, the market's so-called fear gauge, it's signaling profound complacency. It suggests there's minimal demand for portfolio insurance. Investors are simply not paying up for put options right now. It reflects this widespread belief, apparently, that the market has some kind of structural protection against downside risks, which feels fundamentally bizarre given the political gridlock we're literally watching unfold.
I know. Personally, my gut just screams buy protection right now.
Yeah.
Yet the market consensus seems to be completely ignoring that instinct. Why? Why are investors so convinced this tranquility is going to last? What are the overriding narratives that are just drowning out the fear?
Well, there seem to be two really big, almost tectonic forces at play here. First, the market is overwhelmingly convinced that the structural, long-term story of AI-driven productivity growth will act as some kind of permanent floor for equity valuations. They seem to view the tech sector as sort of immune to these cyclical political risks. And second, the prospect of Fed rate cuts is just overriding all the traditional political and macroeconomic risks. Investors seem to believe the Fed must ease monetary policy, both because the shutdown itself acts as a kind of fiscal drag on the economy, and also because the data blackout prevents the Fed from really arguing otherwise, right? They don't have the data to push back.
Okay. So investors are essentially using the lack of data and the political gridlock as justification for a dovish Fed. The famous Fed put is basically overriding the need for portfolio insurance.
That seems to be the fragile equilibrium we're observing. But that low VIX, it's probably not a measure of true stability. It's more likely a measure of the market's intensely singular optimistic focus right now. We're focusing entirely on the future AI growth, Fed accommodation, and kind of ignoring the present risks, like the political instability and the lack of information. The real danger here is that this setup creates a structure that's prone to an aggressive, asymmetric shock, an unexpected negative catalyst, maybe a major geopolitical flare-up, or an earnings surprise. It really challenges that AI narrative, could just shatter this complacency, and it could cause a rapid and violent repricing of risk. We could see the VIX spike really aggressively from these depressed levels simply because so little downside protection has actually been put in place.
Okay, let's pivot now to some individual stock action because the pre-market movers this morning provide a brilliant real-time illustration of this bifurcated psychology we're talking about. We're seeing a complete breakdown, it feels like, between how the market rewards the long-term disruptive story and how it absolutely mercilessly punishes any minor failure in short-term execution. Yeah, take Plug Power, PLUG. It's surging over 34% pre-market. The catalyst is huge. H.C. Wainwright & Co. just doubled its price target from $3 all the way up to $7, and they kept a buy rating. I mean, this is the absolute epitome of a stock trading on future hope.
It really is. And the analyst thesis behind this massive jump, it's fascinating because it connects that long-term hydrogen story to a very short-term immediate macro tailwind. See, the analysts argue that rising conventional electricity prices across the U.S. are actually making green hydrogen a far more economically competitive energy source than maybe previously thought. This structural cost advantage suddenly strengthens the entire business case for Plug Power's technology, and that's what they say justifies this massive uplift in the valuation target.
So the valuation is really being driven by the structural opportunity, the big picture, not by the current financials. And I guess the market dynamics are certainly amplifying the move too, given the stock's history with shorts.
Oh, absolutely. Plug Power has historically been a big target for short sellers. So a major positive catalyst like this price target doubling, it triggers what we call a classic short squeeze. Those bearish investors, they're forced to cover their positions, so they rush to buy the stock back. That just compounds the upward pressure and adds significant momentum to the move, way beyond just the fundamental news itself.
But we should definitely inject the caveat here. This is a story stock, which means we're basically overlooking some pretty tough financials right now to justify this future optimism.
We absolutely are. I mean, despite the powerful narrative and this massive pre-market move, the financial reality is the company faces really significant profitability hurdles. It currently operates with negative gross margins, and analysts project continued net losses per share for the foreseeable future. This is the definition of betting on a deep value narrative over current performance. The market is essentially saying, okay, we forgive you your current negative cash flow because we believe you're building the essential infrastructure for a massive future industry.
Okay, contrast that story with Mercurity FinTech Holding, MFH, japping up over 36%. This looks less like a structural narrative and much more like pure, low float speculation.
Oh, it's textbook speculative frenzy. There's no major singular news event driving this today. This move seems built on a series of recent announcements that were probably designed just to boost visibility. Things like getting included in the Russell Microcap and S&P Global Broad Market Indices, which create some passive buying demand, right? And its subsidiary advising on some high-profile gold asset tokenization project. These are momentum plays. They capture the attention of retail traders who are looking for those quick, high-volatility gains.
And the red flags here are, well, they're bright scarlet, aren't they? Especially when you look at the fundamental valuation.
Extremely bright. This stock just epitomizes valuation detachment from reality. It trades at over 62 times price to book and over 1,300 times price to sales based on trailing 12-month revenue of only about $1 million.
Yeah, this isn't about fundamental valuation at all. It's about low float, high short-term momentum, and just speculative interest chasing a stock that seems largely disconnected from its underlying business reality. All right, now let's look at the flip side of this equation, the swift and, frankly, brutal punishment for any perceived execution failure. Hims & Hers Health, Hims, is trading sharply lower this morning, down over 9%. This follows their Q2 earnings report that showed a slight miss on both revenue and EPS estimates.
Yeah, and the headline miss, it's really only part of the story. The key data point, the one that truly alarmed those growth investors and what the market seems to be punishing so hard, is the fact that Hims reported its first ever sequential revenue decline. Q2 revenue came in at $544.8 million, which was actually down from the $586 million they reported in Q1.
Ah, okay. That's the fatal crack in the growth narrative then. So even though the company reported spectacular year-over-year growth, what was it, 73%, the market just cannot tolerate a sequential deceleration, not in this environment.
Exactly. When a company is valued as a hyper-growth story, trading at over 70 times trailing earnings and still generating negative free cash flow, it's basically priced for absolute flawless execution and just unrelenting acceleration. So a sequential decline, no matter how small, It raises immediate and serious questions about the sustainability of that hypergrowth trajectory,
Hmm.
especially given the intense competition in the markets HIMSS is trying to penetrate, like telehealth and particularly the GLP-1 weight loss drugs. The market is aggressively questioning whether that enormous valuation premium is still warranted if the growth phase might be slowing down. They're definitely selling first and asking questions later on this one.
And then we have Coursera, COUR, declining significantly too, over 8.5%. And this seems due entirely to a C-suite change.
That's right. The catalyst is the abrupt and unexpected resignation of its CFO, Kenneth R. Hahn, effective at the end of October. Now, for investors, an unexpected departure of the chief financial officer, it just creates an immediate and pretty high degree of uncertainty. It forces them to speculate, right? Is this due to strategic disagreements? Has the internal financial outlook suddenly changed? Are there maybe some undisclosed financial issues that the market hasn't grasped yet? This kind of leadership instability has completely overshadowed the company's recent positive operational performance, including those beats on Q2 expectations and even raising their full-year guidance. The market just hates uncertainty, and when the person keeping track of the company's finances leaves abruptly, well, the market reacts by imposing a sharp penalty.
Okay, so synthesizing these four examples, you've got PLUG and MFH winning big on narrative, while HIMSS and KIR are getting hammered for execution failures. What does this polarization really tell us about the collective psychology of investors right now, this week?
Well, it summarizes the current dichotomy perfectly, and it feels like a classic risk-on environment, but with a major, major caveat. The market is clearly prioritizing the disruptive long-term theme. Plug power, even with its negative margins, is being forgiven because of that future narrative, right? The promise of green hydrogen. The market seems willing to fund the construction of that future engine.
Right. And conversely, HIMSS and HERS is getting mercilessly penalized for what seems like the equivalent of a minor dent in the exterior paint job, just a sequential revenue dip, even though the engine itself, that year-over-year growth, is still incredibly powerful. So the market is casting really deep doubt on management's ability to execute flawlessly against that premium valuation they carry.
Yeah, the current environment is definitely rewarding the compelling forward-looking story and aggressively penalizing any flaw, however minor, in immediate execution.
Mm-mm.
And this willingness to overlook current financial challenges just for the sake of a future theme, it reflects an ultimate faith, perhaps even a precarious faith, in technological disruption and maybe that safety net of accommodating central bank policy.
All right, as we move into the scheduled economic releases for the week, we really have to reiterate. The U.S. shutdown has made timely government data incredibly scarce. The calendar is just thin on hard official numbers, and that fundamentally changes how investors have to approach this week.
Yeah, that scarcity, it doesn't just reduce the amount of information. It drastically amplifies the importance of the data we do actually receive. Investors are basically being forced to treat soft data and private sector surveys not just as, supplementary context, but as necessary proxies for the entire economy right now.
Okay, let's detail what's actually left on the schedule and why it matters more than usual this week. Monday looks relatively quiet for U.S. data, but we do have important speeches from ECB President Christine Lagarde and Bank of England Governor Andrew Bailey.
Right, and those speeches are critical for currency traders. They provide real-time insight into where European and UK monetary policy might be heading, which contrasts pretty sharply with all the uncertainty surrounding the Fed right now. Then on Tuesday, we get the U.S. trade balance for August. Now, while that's useful for monitoring trade flows, its impact is likely to be highly muted this time around. The market's focus is just squarely on inflation and employment, which are the areas starved for data.
Okay, Wednesday is marked by the release of the FOMC meeting minutes from their last meeting. Now, this is always important, but how is its relevance magnified right now, given everything?
Oh, the minutes become a true deep dive into the Fed's internal debates this time. Investors will be scrutinizing that record, not just for the consensus view on resuming rate cuts, but far more importantly, for any explicit discussion about how the data blackout is actually affecting their decision-making process. We really want to know if they're explicitly acknowledging that they're flying blind, and how they might plan to incorporate these more volatile proxy data points. That kind of nuance could set the tone for the next several weeks. Also on Wednesday, we anticipate the Reserve Bank of New Zealand rate cut. That looks like a certain 25 basis point move, which will definitely drive the Kiwi dollar.
Right. Then Thursday gives us the U.S. weekly jobless claims. Normally, this is kind of a marginal market mover, but probably not this week, huh?
Precisely. Jobless claims is one of the very few timely, government-produced labor market indicators available right now. In the absence of non-farm payrolls, this single number becomes disproportionately crucial for assessing the near real-time health of the job market. Any unexpected spike or drop in claims will be intensely scrutinized. It's really the only reliable labor market signal we're likely to get this week.
And finally, Friday brings the preliminary University of Michigan Consumer Sentiment Survey. This feels like the ultimate soft data that has suddenly become hard data.
Yeah, this survey becomes a real bellwether this week. It's the first high-quality look we get at how all this political turmoil, the shutdown, the media focus on the data void, is actually filtering down to the psyche of the American consumer. A sharp drop in confidence would signal a potential pullback in discretionary spending that would immediately reinforce those dovish arguments for the Fed. Conversely, a resilient reading would suggest that consumers may be looking straight through the political noise, continuing to spend, and that would provide critical support for equities. This one survey, it's going to command significant market attention, far more than any actual hard data released under normal circumstances would.
Okay, and this week also marks the unofficial beginning of the Q3 earnings season. FactSet estimates are indicating the S&P 500 is actually set to achieve about 7.9% year-over-year earnings growth. That would be the 9th consecutive quarter of growth, which suggests some underlying corporate resilience. But that guidance, that's now more important than ever, right?
Oh, absolutely. The shutdown crisis has effectively turned corporate earnings into an essential economic proxy. With government data delayed indefinitely, corporate earnings reports, and maybe most critically, the forward-looking guidance provided by management, they are arguably the most trustworthy real-time indicators of economic health that investors actually have access to right now.
We start off Monday with Constellation Brands, STZ. That should offer some insight into premium consumer beverage spending. But Thursday looks like the major day, with two real giants reporting before the market opens.
Yeah, first up we have Delta Airlines, DAL. Expectations are for EPS around $1.83, revenue about $15.9 billion. But for investors, the focus really has to move beyond just the headline beats or misses. We need to scrutinize the commentary, especially on the mix between that high-margin corporate travel versus leisure demand.
Right. Why is Delta's commentary so particularly important as an economic proxy right now?
Well, because Delta's CEO commentary on future travel budgets, on business sentiment, it's arguably a superior leading indicator of overall business investment right now than any delayed government report we might eventually get on, say, factory orders or industrial production. If Delta reports robust corporate bookings, if management expresses confidence in business travel spending looking forward, it suggests that CEOs out there are still committing capital, still viewing the economic outlook somewhat favorably, irrespective of all the noise coming out of Washington.
Interesting. Okay, the other heavy hitter is PepsiCo, PEP, also pre-market Thursday. Expected EPS is $2.26 on revenue of about $23.9 billion.
Yeah, PepsiCo is just a crucial barometer for the health and, importantly, the price elasticity of the global consumer. We'll be watching several things closely there. Organic sales growth, how much of their revenue increase is coming from actual volume versus just price hikes. We also need to monitor the impact of input cost inflation, maybe tariff policies, on their margins. Analysts over at UBS have already anticipated a challenging quarter for them, which really puts the focus squarely on management's ability to maintain margins through strategic pricing. Their insights provide a direct, real-time window into prevailing consumer demand and inflation trends that we simply cannot get from the delayed CPI or PPI data this week. #Tego outro. Okay, so summarizing this really unique week for you, the listener. The market is clearly operating with this deeply bifurcated mindset. On one hand, you have palpable bullish momentum, driven globally by that huge Japan rally, structurally by the persistent AI growth story, and domestically by this conviction that the Fed is basically forced into an easing posture. But all of this confidence is just shrouded in this deep macro fog created by the U.S. government shutdown and the data void. Yeah, tactically, the path of least resistance for equities probably still appears higher, mainly supported by that strong dovish Fed conviction. However, this environment is just. It's precariously positioned because of that deep VIX complacency we talked about. That tranquility feels brittle, and the market seems highly susceptible to an asymmetric shock.
So the key takeaway for the week, therefore, is that the most probable sources of any market-moving surprise will decisively not be official economic data.
Absolutely not. The surprises, if they come, will likely come from corporate earnings guidance specifically, management's outlook for the future from those bellwethers like Delta and PepsiCo, or potentially a significant unexpected shift in consumer confidence revealed by the U of Michigan report on Friday. Those are your real-time economic proxies this week. They're effectively replacing the Census Bureau and the Bureau of Labor Statistics for now.
Yeah. And that willingness of the market to reward a compelling future growth story like Plug Power, while simultaneously overlooking its current financial flaws. It really is the ultimate expression of faith in disruption and maybe accommodative policy. It's just a fascinating tension between hope and reality playing out.
So the final provocative thought we want to leave you with, given the sheer magnitude of uncertainty stemming from this data blackout, is this. How long can that resolute optimism actually sustain the low VIX before some unexpected shock inevitably forces a violent correction? And maybe more practically for your own portfolio decisions this week.
Sure.
What information signal? Is it a CEO's commentary on corporate budgets, or is it a survey of the average American consumer's psyche? What signal will you trust the most when all the reliable hard data is absent?
That's definitely a deep thought to mull over as you begin the trading day. Thank you so much for joining us for this deep dive. We'll talk to you next time.